You're tuned in to Agriculture Today, and we start our Wednesday show with K-State and Washburn law professor Roger McEowen. Roger, thanks for joining us today.
Good to be with you, Shelby.
Roger, talking through some potential legal and tax issues today, and starting off with a trade or business activity. And what is a trade or business activity?
Well, that's a big issue when it comes to tax because that concept undergirds a lot of things that we deal with in the tax world, and it really matters. And unfortunately, there's confusion sometimes with respect to when an activity rises to the level of a trade or business and what significance that means when it does, or what are the problems that occur when it doesn't, when an activity does not meet the standard of being engaged in as a trade or business activity.
And what are some of the different activities or components that make it a trade or business?
Well, regularity and continuity is the key. Really, it's a fact-based determination. There's not one thing that's key. IRS has tried to argue that over the years, and in fact, it came up with respect to CRP payments a number of years ago, where the USDA tried to take the position that once you put your name on a CRP contract, you are engaged in a trade or business activity, and therefore you have self-employment tax on your CRP rents. Well, that's completely ridiculous. That's wrong, because there is a U.S. Supreme Court case on this, which says it's a fact-based analysis. We don't look at a signature on a contract and say that that's conclusive to determine whether the taxpayer is in a trade or business or not. We have to look at all the facts and circumstances. And the case they decided, which gave us that standard, involved a fellow that was gambling, and his primary focus was on greyhound races. And he tried to claim that he was a full-time professional gambler engaged in a trade or business of gambling so that he could deduct fully his losses. Normally, you can't do that for gambling losses, but if you are full-time engaged in that activity on a regular and continuous basis, you can. And he won that case based on, the court said, all the facts and circumstances. So that's the key in determining whether I am engaged in any particular activity as a trade or business. So if your facts don't match up and you don't have a profit intent, then you're probably not going to be deemed to be in a trade or business, which is really going to hurt you if you lose money. You're going to lose the ability to deduct those losses. And, of course, the downside is, as I kind of hinted at, if I am in a trade or business activity, then that's going to go on Schedule F of my farm return, or Schedule C if I'm a non-farmer, and I'll have to pay self-employment tax on that.
Is this a really good time to maybe talk to a professional if it's a little confusing?
Yeah. These issues, you should always have good tax advice.
And when we're thinking about taxes, talking about income tax, and what's the impact of income tax potentially?
Well, income tax basis is really what we focus on in determining tax outcomes in just about every situation. And what basis means is, in essence, what do you have in an item? What's your investment in an item? What do you have in it? And the way to think of basis, I think the easiest way to convey it is, how did I acquire an asset? And if you break it down that way, you can acquire an asset in three ways, essentially. And that would be, I purchased it. Well, my basis in that, what do I have in it? What's my investment in it? That'd be my purchase price. So that establishes my basis. And basis is important to know because then if I sell the asset later on, now let's say it's a business asset, I sell the asset later on, I'm going to have some taxable gain. Well, up to my basis, it's not taxable. If I sell it above my basis, then I've got tax on that difference. And so I need to know what my basis is, because if I can't establish what my basis is, IRS can take me to zero and cause all of that gain to be taxable. We don't want to do that. And there are plenty of cases out there where taxpayer didn't preserve enough records, couldn't substantiate what their basis was, and so the IRS said, well, we're going to assume you have zero basis and all of your gain is taxable. So you want to know what your basis is. So the first way to acquire a basis is maybe you purchased the asset. Another one is maybe you inherited the asset. Well, there's a different rule on basis for an inherited asset, and that is your basis in the asset you inherited is equal to the fair market value of that asset at the time the decedent died. So we call that typically a stepped-up basis. because you get a revaluation of that asset from the time the individual owned it to the time of death. It goes to the value as of date of death. And that can be pretty good in the hands of the recipient, because if they then turn around and sell the asset for its fair market value shortly after the individual died, then there is no taxable gain. You basically sold it for the same amount as what you have as basis in it. Another way to acquire an asset is it could be gifted. Could be gifted to you. Different rule in that situation. In that situation, the recipient of the gifted asset takes the donor's basis in that asset, the person that gifted the asset to them. So if that person has a low basis, I get a low basis. If they had a high basis, I get a high basis. So we need to know what basis is. Basis undergirds many, many tax concepts, and we need to know what that basis is for determining our tax consequences if we dispose of that particular asset.
And with the asset, what happens if improvements or depreciation has taken place with it?
Well, then we get an adjusted basis. And so I have to modify my basis during my period of ownership of a particular asset to reflect improvements to the property, which would increase my basis. Depreciation that's allowed or allowable under the code decreases my basis. So there will be adjustments, and there are other things too, but those are the big ones that cause adjustments to that basis over a period of time. But then if I die owning that asset, then everything steps up to fair market value. We don't worry about all those adjustments. We just revalue it at date of death and we start over again. And that's a very important rule for farmers and ranchers, because there are a lot of low basis assets that farmers have, particularly land that's been held, for example, for decades. You know, Shelby, you might be the favorite great-granddaughter or great-great-granddaughter, and your great-grandfather, let's say, bought a tract of land in 1940. And before he dies, and he knows he's coming down to the end, and you're the favorite great-great-granddaughter, and he wants to see you own that before he passes. And so he's got a deed ready for you. And if he gifts that to you before he dies, you're going to get his 1940 basis in that property, with some adjustments. But basically, you're going to have a low basis. Now, if he were to die and leave it to you, you're going to get a basis equal to 2025 value of that land. So it makes a difference to you, a big difference in these situations. And of course, there's been some legislation talked about in recent years of changing the basis rule at death, not getting a complete stepped-up basis, and that's a really big concern for agriculture.
Is this a time then when we're thinking about all these income tax bases, keeping track of records? Absolutely.
You've got to substantiate your basis, because the burden is on you to establish what your basis is. You have to prove that. And there are a number of cases. We could sit here and talk all day about the cases that are out there where taxpayers have failed to fully substantiate or at all substantiate their basis in property, and we can see the problems they get into. So good record keeping is a must.
And as we're talking about land, like-kind exchange of farmland, and what is that?
Well, that's a rule under 1031 of the Internal Revenue Code that allows me to defer paying tax on transfer of land until I would sell the replacement property I receive in an exchange. So as an alternative to selling land and buying another tract, which would be fully taxable in the year of the sale, what I could do is find somebody that wants to give up a tract. I want to trade that tract for that tract. They want to do the same. So we just swap. There's no tax consequence to that. There can be. But if I'm going bare ground for bare ground and it's of equal value, then there's no tax consequence. Now, if we have unequal values and there's cash boot that's thrown in, then the cash becomes taxable. Or if I'm trading land that I have buildings on, let's say I have a farm building, I have grain bins, I have fences, those types of things, which I've claimed depreciation on, and I exchange that for bare farm ground, then I've got some property that has a depreciation recapture component to it. That's going to be taxable in the year of the trade. The rest will be deferrable. But if I've got depreciation recapture on assets that are involved in the exchange, and that comes up when I'm trading land with improvements on it for bare land, then I can have some tax consequences.
So quite a few little necessities or little factors that go into this then?
Yep. Very complex, yeah.
And just one last thing included in this blog article, what is a cropper?
Well, a cropper is somebody that's to be distinguished from a tenant or an employee. And so a cropper is somebody that comes in and harvests a crop, and you provide the equipment for them. They're just providing their labor, and they harvest the crop for you, and they're paid basically a wage to do that. They're not an employee, but it's a contract-type situation. And so they're not treated as a tenant under tenancy laws. So the farm tenancy laws in Kansas or other states would not apply. They're not entitled to, for example, notice of termination of their tenancy because there is no tenancy. It's just a service. So you'll have a custom cutter would be pretty close to what a cropper is. There's some nuances there, but that's the way you want to think of that. An employee is somebody that works for you is for a W-2 wage, and there are different legal relationships there. And then you have a tenant that is entitled to notice of termination if you want to terminate their lease. So it's just differences in the way the law treats the relationship between somebody that is planting and harvesting a crop based on their status.
Roger, I appreciate you taking the time to join us today.
Thank you, Shelby.
That was K-State and Washburn law professor Roger McEowen. I will link his blog article titled Trade or Business, Income Tax Basis, Cropper, and Like-Kind Exchanges in today's show notes on agtoday.net.